Hey guys, and welcome to our first episode of Let's Talk About It. Come on, let's go.
Welcome everybody to Let's Talk About It. And today we are talking with
Raleigh Davis with the Federal Savings Bank, a mortgage lender based here in Chicagoland.
your local lender right here.
In Chicago.
But you're not originally from Chicago.
I'm from Ohio. Go Browns.
We'll let it slide a little bit. The myth is you need 20%, but you really don't need 20%.
But you don't. And even if you have that 20%, do you necessarily want
have to put
all of it down?
20% down.
Anyway, I wanted to talk a little bit about the myth that exists in real estate or mortgages that you have to put 20% down in order to qualify for a mortgage.
Okay. In your years of doing lending, at least the last 3, 4, 5 years, what's your typical down payment?
I generally suggest to buyers, even if they have the 20% down to put on a property, to go with the 10% down. I kind of believe 10% is a nice sweet spot with not necessarily putting everything you have in the bank into your house. You want to stay liquid to some extent in case a furnace explodes, or
Yeah, you're gonna need a few $1,000 for a new furnace. That's for sure.
or something equally not positive that could happen. And you want to make sure that you have some reserves in the bank to address these situations. And here we have an Excel sheet that kind of looks at the payment breakdown for a 30-year fix, what the payments would look like at 5% down, 10% down, 15% down, and 20%. HOAs are the fees that you pay to a condo, for instance, the elevator, or paying for the door guy. You're going to be paying HOAs.
Maintenance, common insurance.
Correct.
Snow removal.
Yeah. Really? Snow removal?
Yeah, well, typical HOAs in any building is lawn care, lawn maintenance, snow removal, common insurance, and then usually whatever common electrical bill there is.
Fun.
You'll have outside lights that are part of the building.
That makes sense. If you do not put the full 20% down, you have to pay PMI, or private mortgage insurance. So if a borrower puts down less than 20% on a home purchase, they're obligated to pay private mortgage insurance. Here you can see this is for somebody with a 750 credit score, what the monthly mortgage insurance costs are at 5% down, 10%, 15%, and 20% down. At 20% down, they're not paying that mortgage insurance. So what to keep in mind here is what the payments would look like and how they differentiate at option A, 10% down, versus option B, 20% down. So in this case, the monthly payments would be different by $210 at 20% down versus 10% down. At 10% down, they're paying $22.79 monthly. At 20% down, they're paying $20.69.
Okay. 20% down, you're putting $60,000. If you're only doing 10%, that's $30,000. For your average person, $30,000 is a significant amount of money.
Significant.
PMI insurance goes away once you hit that 20% mark, right?
Once you hit
the
that,
80-20?
The 80-20, once you get to that 20% down.
Is there, hypothetically, let's say our client or whoever has mailed in their mortgage or sent their payment in, and with that payment, now they're at 80-20. Is that something that will automatically happen? Or
meaning
we bought the house, we're 4 or 5 years into paying the mortgage.
What did they buy it at? Percentage wise? Like 10% down? 15%?
Well, yeah, let's just say 10%. I'm saying, so once you get to that 80-20, now then, do you need to do some other paperwork, or is this something that's going to just automatically
It will
not show up on your bill anymore?
It will disappear.
Does their credit come into a factor?
Credit is
with
a
the
huge
PMI?
factor.
Okay.
Somebody with a 650.
I mean,
yeah.
because regardless, you need that credit for the loan in
Yeah.
the first place, and that's why I want to ask if, again, does your credit really come into a factor with the PMI?
It absolutely will. For qualifying for any conventional loan, I believe my bank sets the underlays at a minimum 620,
620?
620
Okay.
or 610 credit score, which even if you do have
So you
below
don't
that,
need a 750 and
you
above
don't
credit
need a
score.
750. However, anything above 680 will lead you to better pricing.
Okay.
So
A better rate.
better rate, which at the $300,000 purchase price, the rate isn't everything. I'm not saying it's nothing, but if you're just trying to get into a place, then the difference between 4.5 and 4.5 interest rate versus 4 flat is probably $70
A month,
a
right?
month,
Okay.
which is all relative. You can just think
Yeah,
about
I mean,
that if you're
70 bucks a month, but I mean, it adds up over.
It does add up
over
over
time.
time. So if you want to improve your rate, get credit healthy, is who I work with.
Which is actually going to be one of my other guests we're going to have on as a credit repair guy that I want to get on here. And,
Who's he with?
he actually has his own company. He's been doing a great job with it.
Give me his information, man. I'd love that Chicago.
Jay the
guy.
credit guy.
Jay the credit guy. I am a big believer that people, before they start searching for homes, as opposed to meeting with a realtor, no offense, should meet with a lender so that they can paint the picture of
Yeah, I mean,
what they qualify for.
I tell people that.
Yeah, exactly. No, that's good.
I appreciate that I'm your first phone call, but I should be your second phone call.
Exactly.
Maybe third phone call.
Who's the other one?
Home insurance?
Yeah, that's.
Nah.
Eh,
Your local gym membership?
yes. Do I look fat?
No.
Grown like a fourth chin since December.
I think most of this office is doing a diet competition.
Oh, yeah,
or-
weight loss challenge?
Yeah,
Yeah,
weight
so am
loss
I.
challenge or something like that.
Basically, you want to understand the difference between what you qualify for and what you can comfortably afford. And a lot of that is on the buyer to decide. You know, they might make $100,000 a year, but they only want to spend $1,500 a month on their house. Because that's what they're comfortable with. Good for you. That's, you can get X amount for this monthly payment. But you want to understand and back it up with paperwork. That's tax returns the past 2 years, pay stubs the past 2 cycles, savings, bank account. Take a look at what the reserves are so that I can give a pre-qualified, a pre-approval letter with a vote of confidence as opposed to,
Sure, this is what you're pre-approved for,
Yeah.
and it's not even close.
Yeah, exactly. Because at the end of the day, it just wastes everybody's time if
Yeah.
the lender doesn't do their homework on the front end.
Nobody wants to waste time. Well, I appreciate it, sir.
Thank you, Jason.
Thanks for coming out and giving us a little in-depth analysis of educational financing.
Raleigh Davis, Mortgage King of Chicago.
Mortgage King of Chicago and the Open House King of Chicago.